Good day, gentlemen, and it's reset sniper time. And wow, I've been having a bit of a feeling in the water that's come around me for a while, and you know that I have assessed that there's a massive reset coming. The whole essence of this channel is that beyond the scale of 2008, there will be a full-blown economic reset that comes. It's the reason why you watch, because you want to understand and have a feeling as to when things are at a higher state of urgency, emergency. The most common question I get is not people questioning whether the reset will occur, but the question I always get is when. And the key point is, I can't ever tell you when, but I'm here today to tell you that in my view, things are as precarious as they have ever been. And there are a kaleidoscope of current political shenanigans that could create an instant escalation which could bring it about. So what makes me say what I say specifically about events currently? I mean, you guys know I've been around and we've listed many things. Well, stocks are close to their highs but have not surpassed their January highs. The US indices markets close to all-time highs but have not surpassed them. We'll be coming back to stocks and equities indeed. Sky high valuations for those securities, particularly the mega corps. We'll come back to this. I wanted to do this video. It's been brewing in the back of my head for the better part of many days now. And since planning it and deciding to go public with you, but continuing postponing and got delayed today, all the events surrounding Facebook came out. So we'll be referring back to that. So while I say stock valuations, I almost feel that I was delayed kind of counterintuitively due to all other activities, and who knows, another shoe might have dropped there, but we'll refer back. The debt levels in US corporations are beyond all reasonable levels. They are at record levels. In other words, what has been happening, and I mentioned this before, so it's not a new point, but it's just a reminder of what makes driving. I remember somebody saying, if you want people to drive more carefully, leverage isn't an evil thing. People drive more carefully. If you tape a dagger pointing on their chest, believe me, they'll drive a lot more carefully and you won't have issues. And derivatives are just like that dagger, and my answer to that is, mate, maybe they'll drive carefully, but when things go wrong, they're going to go badly wrong. And this is the same thing with debt and with derivatives, but more on that to come. So record debt levels in those same corporations that are at record valuations. So normally, as you borrow more money and your loan to equity is going ever higher, the accountants and the market evaluators and analysts look at this and say, this is not a good thing. Let's be clear, much like government, where a dollar borrowed used to give a couple of dollars return, then $1.6 return, then 1.3. You now get 44 cents for every dollar that's been created in quantitative easing in return. So you're creating more debt than you're getting growth for that debt. Yet that unit of debt doesn't go away, it sits there and it demands babies. It's a compound, it's an tertiary extracting unit that this demands to be fed in interest payments. Now, in one of the stats that are particularly worried on listed stocks, there are 10% of listed stocks who actually are now borrowing to pay interest on previous borrowing. New borrowing to pay interest on previous borrowing. Throughout this process, the CEOs have continued to say, the cheapest equity is debt. because you don't own and you don't owe an earning stream with a dividend that goes with that, especially while the Fed has been the master of low interest rates environments. And this all started way back in 1987, the beginning of my investing, and you can call it eventually trading career, when we had a huge crash and Greenspan had just taken the reins and Volcker had stood down. And Volcker had broken the inflation genie early in the 80s when gold pumped. What ended up happening is Greenspan became Mr. Liquidity Experiment. Every time there was a setback, he opened the taps and reduced rates and created liquidity, and he was very, very late in terms of taking the punch bowl away. So the 87 collapse actually recovered quite quickly. By the time I'd finished my 2 years military service, despite investing literally 1 or 2 weeks before a crash that ended up taking about 40% of my overall net worth away from me, and everything I had was literally in that, barring a bicycle and a second-hand car and a few CDs. That was literally how badly I was hit, and you can say the bug bit from then. But my personal narrative aside, that was a Greenspan error, and he rebounded that with the liquidity. No one has ever dropped his pants as far and as fast when it's come to proliferating new money into the system. So very shortly after 87, we got bounced into a 94 crisis, 98 crisis involving long-term capital management. Again, big punters, hedge funds with the masters of the universe, brain-wise, Myron, Scholes, etc., etc. And how did they solve that? Interest rates cuts, and they collateralized and put the taxpayer as backstop. Anyway, I don't want to go further down that rabbit hole. It's a video of a separate nature that I've already touched on before in previous works. So what's actually went on, we then expanded into the globalization era. Now here's an important point. When we went global, in other words, China became the sweatshop, workshop, and India to a degree, and certain emerging major nations who were working for $1 a day, where you would normally have paid much more than that to an American and a European worker. We got sustained low product inflation. In other words, companies were still making supernormal profits, but the cost of producing that, Walmart grew hugely off this. Walmart is the retailer of China goods, in essence, in the States, and is an example of one of many. They're not the only ones, but this is all the workshop of the East at low wages doing all this work. What ended up happening is we were allowed a much lower level of interest rate because there wasn't inherent inflation in consumer products that used to be there, where you had to pay a Detroit worker a pension, a normal Western salary wage, etc., and all the perks that were typical. So all these workshop elements were transported out of America, and this is a topic that Trump refers to a great deal, but I'll refer back to that as well. So park that thread for a bit. So in understanding this, we actually had too low in interest rates, but it was artificially due to a benefit of globalization, where the costs of producing actually went down as we globalized. So instead of having our clothes and our t-shirts made down the road at the local, and Britain, all the apartments are named after the hat factory, the candlesticks works, that was industry that was from the 50s when Britain was an industrial giant, and that got shed when they became sick Britain, and it all got transferred into Europe, Japan, and everything. And then we had a second level of that, where even America and Europe bled out core manufacturing into the cheapest sector. So this led to much lower inflation. People could buy more goods, they were costing less, yet supernormal profits were still being made, and normal profits were still being made due to the low cost of productions. And so interest rates during this period were kept artificially low, which took us into the dot-com boom, the smash, bash, and crash there. And then the same solution by the same individual, Greenspan. Low liquidity dropped to very low rates, pushed us into the property boom with a whole bunch of malfeasance, Reuben Clinton administrations removing Glass-Steagall Acts, etc., churning the banking system into casinos. Covered this in much greater depth in other things. So this all created collateralizing, deposit-taking banks with casinos so that they became too big to fail. So most of you have got that, they follow this channel. Now what actually could be a trigger and should be a great concern for you is a number of things. Trade wars and or currency wars. If you try in this incredibly over-indebted, throughout this period with super low level of interest rates, we could all eat more debt because it was affordable, we could pay it. So now Americans have 7-year mortgages on GMC trucks. They don't even know what they paid for the vehicle. They can afford the payment. They're going to buy about 40% of it over 7 years, and they're going to hope to hell that the residual value is going to match, or they might have to pay in to see it go and start another agreement of similar nature. This is the financial engineering that allowed for high prices, but affordability with this low interest rate environment. So it's proliferated bubbles and excessive consumption. Now what now happens is if we reverse that process, because we say, no, we want our hats and candles made here again in Britain and in America, and never mind those Chinese people, they're bad people, we want trade war, we're having a trade war with them, we're going to put tariffs on their stuff to make them relatively more expensive so that our locally made products can compete and basically push up the cost of materials. Now imagine something like Walmart, for example, or anything like that, suddenly all goods, and this hasn't happened yet and it's not levied at all goods, but any essence of a trade war is going to push the cost of living up. It'll create a mini boom for local workers that will start to get basic work again at one level, but it'll push prices up. Now the key thing about pushing prices up is it means the cost of living is going up, and that's inflationary. Now any time and the reason why I feel that there's a great danger is this political game is now being kicked into the foreground. On top of that, the Fed started increasing rates in December 2015. And actually, the rate at which they're claiming to do so has and intend to, in terms of forward guidance, is at an accelerated pace. This is causing tension between Trump and the Fed, and there might be ructions that he'll rejig Powell or any of the other people around him as a sort of shot across the bows, because increasing rates is the big beginner for all recessions. The end of an interest rate increasing cycle is always a recession. In normal circumstances, a recession. Yes? So people are saying, no, too much party, take away the punch bowl, too much spending, too much high hog, too much debt being built up, make it more expensive. Suddenly those people, as they start ratcheting up and squeezing your nuts, the eyes start to water and people start dropping. Businesses that were marginal, that should never have been able to survive, but were kept alive on cheap money, start to drop. Consumers cease to be able to spend. So even decent businesses, not exceptional ones, but decent ones that's getting enough business, suddenly have a major fall in consumption. They lose 30% off their revenue mark. They have to close their weaking stores. They have to hold on to only the best stores. Schmuckbucks, I mean Starbucks, the non-tax-paying multi-corporate very crap coffee company, is closing stores. And they keep trying to be cool and talk about transgenderism to hide the fact that they are major into store closure as a full-blown corporatocracy, and are shutting stores for lack of profitability. So what we start to get is even decent companies that could have survived on moderate consumption, have done pretty well in excessive consumption, won't survive in below average consumption, not in their current state. And once you drop 30%, you pick up more debt, and you pick up more of what's currently starting to cost you more. And eventually you say, we could have survived if we could have just gone straight to right sizing to that smaller, tighter business, and we took a lot of cost out very quickly. But people hate that. They don't want to have to fire and rehire. And by the time they realize the market's not coming back this time to average or above average levels. Why won't it? Because there is a bubble so big in debt, it is positively huge. Note, I haven't even mentioned bonds. Bonds are the biggest bubble, and they are created by governments, essentially. But corporate debt is huge as well, and that's what we're mentioning it. Now, the interesting thing, and I read, Rycott, Simon Black. A lot of people will be tributed with giving me information. Harry Dent, and my own research. Lots of opinions will be collaborated in this opinion piece that I'm giving you. But the interesting thing about all of this is that we are overly indebted to the nth degree in corporate and especially government gilt debt. And the bond market has had a bull since 1982. Think about that. When Faulkner broke inflation and it virtually nearly touched, I think it went over 20% for a smigment, or was 19 or 18. Since then, you've had a non-stop reducing rate of interest for the better part of now almost 40 years. It's 18 years to 2000 and it's another 18 years. That's 36-year bull market in bonds. Now we're starting to get to a point where the yields are going to get close to flattening and inverting. Now that's going to sound super technical to most people and they don't understand it. That is also a classic recessionary based signal. What does it mean? Basically, you're comparing the yield between a 2-year and a 5-year treasury risk. Now, the treasury risk typically should be higher for the longer term. There's more chance for something to go wrong. So it's priced in such a way that it reflects that. If you hold the debt for a short period and you get paid out and you sell it, it's no big issue. You get redeemed quite early. There's much less opportunity for something to go wrong. What then starts to happen is interest rates are so low that the curve starts flattening and people misprice the much larger, longer period of holding debt, and you get priced for perfection for infinity years, like there's going to be no bumps in the road for an extended period. And that is always a sign of recession because it reflects complacency. So here we have all of this. Super leveraged corporates buying back their own stock to pump them up. So we have a very inflated stock market, but indices can kill you and grind up higher longer than you can afford to be right. But eventually the straw will break and you will get the big short. The big short, for those of you who saw the movie, the equivalent of the shorting of the collateralized debt obligations on subprime debt that were deemed utterly crap by the star of the show, who was harassed by the feds no end and the IRS, etc., 3 or 4 times, while not a single Wall Street fraudulent banker was ever arrested or even interviewed about that state. So you know who your control structure is when it comes to how they behave. So here you have, let's recap, stocks super high valuations but can't take out the January highs. So now we've had put a stake in the ground and we're battling to reach back up there. Sky high valuations for securities that are more indebted than they've ever been and have actually used a lot of that debt, cheap money, to resign equity that they had to pay earnings and dividends to that were very close to the interest rates they pay on the debt, in some cases even more. So it was deemed cheaper. So they become incredibly heavy in debt. And investors and pensions, that many, particularly government pensions, are largely deemed bust and that will not exist. 1 in 3 are deemed not to be able to exist and to meet their commitments. And those same pension investment vehicles are the ones holding this corporate and government debt and relying on those interest payments to pay you, yes, you, Mr. State Worker, and you, Mr. Private Pensioner, and you, Mr. Auto Car Maker, that's now sitting 5 years into your retirement, your pension. So this is the scale of where we're at. The other thing is on new Fed chairmen, and I've done a YouTube on this, the control structure likes to do a reset. That way he gets to fix or be part of the solution and was unlucky it was given to him. It's something he inherited, he doesn't get pasted. The guy before who contributed a lot to it has bowed out, aka Yellen, who relieved Bernanke, who relieved Greenspan, etc. So you have a litany of people that continue to add to debt, often because they barely had any choice. Plus, you have a government that continues to increase its debt ceiling and is going to push on 1 trillion deficit and already has 21 trillion. Go understand the scale of 1 trillion to truly get what I am saying to you about how bad that is. I do that example where I say counting in seconds to 1 million would take you 12 and a half days if you counted 1 second every match, every dollar that was owed. To do 1 billion would take you 32 years, and to do 1 trillion would take you 32,000 years. You halfway back to dinosaurs being around. 2 trillion would take you close to dinosaur era. So, I mean, this is incredibly serious. Then we have a super elite mega corporate that has gone unfettered by government. Microsoft faced antitrust action in the 90s, etc., from Europe for bundling in its browser and everything in pushback. You have Google stroke, YouTube stroke, Android stroke, everything. And the reason this is because they are essentially the outsourced CIA's tech division. They are backdooring and hosting everything you do, say, and data farming you into oblivion so that you can be profiled, that you are known, you can be tracked, and you can be controlled. That is the only thing I can think of as a legitimate reason as to why this company has not been broken up into a million pieces, million tiny disparate pieces that are all forced to compete with each other. You have the likes of Apple all supposedly, while claiming to be premium and pretending that they don't do the same, doing exactly the same, prostituting you. And these have been the lead steers. So the indice trackers in the investment realm have outperformed because they keep buying the big caps that keep going up faster than the rest of the market. And indices often outperform active management. Generally, they're the better investment. But what you eventually have is you then get a Nifty 50 or a FANG sector, which is so heavily backed and supremely priced for perfection into the future, because all the money just keeps backing him and buying him, that it's almost as if there will be no further bumps in the road into infinity.com. And you've got to remember that I think Amazon fell from $94 to about $77 in the dot-com boom. Good company that it was. So don't think for a minute, and this brings me to Facebook now, don't think for a minute you can't lose 80% in the stock market just because you own the big giants that are consumer used in every single way across the globe. People will stop replacing them. They will run the equipment they have twice as long. They will demand cheaper, lower margin products if they replace them. They will buy alternatives and they will scrounge, and the feel-good consumption factor will disappear. Those that paid $85,000 for a GMC truck with a 7-year mortgage will be battling to sell them for $19,000 18 months into that contract. There will be delivery dealer stock parked on airports that it will go so big as the manufacturers keep stuffing the pipe and forcing guys to do finance deals. A lot of the money is made in the banking, and everything has become financially leveraged. That a truck in the States is like buying a small house, in that it's HP, it's interest, it's all the extras. Nobody knows the value of the item they're buying. They only know the monthly payment. Nobody understands they're not buying 100% of the item. There is financial engineering everywhere in our economy. It should have been backed out long ago. They are an absolute oligopoly. They are parasitic. They are tertiary extracting destroyers. And when things go bust, they get bailed. And you suffer. Your credit, you didn't pay. Take it back. Work longer hours. Get another job. Sweat, sweat, sweat. Otherwise, you will have your house taken away from you. That is what will come. So, 34 months is calculated. This comes from Simon Black, so to credit him with him. 34 months from when a cycle, an interesting cycle starts, an interest rate cycle starts, is typically the period by when a recession starts. Now that is a broad number that is taken from a number of statistics. Sometimes it's been more, sometimes it's been slightly less. This is not normal times, and this will not be a normal recession. Because we are driving the car with daggers 0.5 millimeter from our torso, and we're doing 200 kilometers per hour, and we've thrown the third bottle of tequila into the back, and there's a concrete wall at the end of this freeway because they didn't finish building it. And the brakes are worn and haven't been replaced for ages, and there's no handbrake. Okay, that is how we have geared through leverage and derivatives. In other words, it's bloody in terms of how it'll be as a mess. Very, very bloody. And most people think it's okay because that speed has built up, that alcohol in the system was built up slowly, and the knife got slowly longer and longer and closer and sharper. That is now pointing right on my sternum, barely a few millimeters away. And if I get thrown forward, I know my seatbelt is virtually frayed to non-existence due to lack of maintenance. So the analogy is a powerful one, and we are heading there. So 34 months from December 2015 is, in fact, the October-November period when crashes typically occur here in the Northern Hemisphere. So crashes are September, October, November, and the follow through there. Sometimes they start withering in August while everyone's on summer break, and the controls are left lit, and it's kind of like that Starship Enterprise. Everything is shaking and bits are falling off. Or Han Solo's aging old bucket of a ship. This is where we're at. It's getting shaken. It's been shot up. It is reverberating. And this leads me to believe that the Great Reset could be triggered by the fallout wars. Then you take the politics. Then you take what's happening with China and Russia. Trade wars push prices up. They put a little bit of heat in the economy and get some domestic going, but they push prices up. The control structure likes crashes on Republicans. So they made Bill Clinton look the hero, although he built up an immense amount of debt for submitting a surplus when you had America at their most productive. The baby boomers, 47 years is the most productive age. He was president during that period. That's just plain luck. He doesn't understand economics any better than anyone else, and Bush cleaned up after him and got 9/11. Then they gave Obama a clean run, and I think Trump is the guy to be the fall guy. He's liked to be loathed, and they want the leftist agenda to win because it's a communistic mentality that they're foregoing. He will be the guy that was at the controls during the crash. And actually, presidents have very little consequence on economy. They inherit an entire cycle, an economic cycle that has gone by decisions made before. And it is a case of pass the hand grenade, where someone long before you pulled the pin, and you just have to make sure that you're not on the 10th second. You're the 9th or the 7th or the 6th second, and you're bloody good at ducking. Because it's your head that gets blown off, and it's you that all the sheeple will blame, who simply do not understand the irresponsible decisions that set all sorts of things in motion, from Greenspan all the way through .com, subprime, and everything else. So this is an exceedingly precarious time and moment. This is an exceedingly precarious time and moment. And typically it's recessions. Actually, in my perfect, stark opinion, we were in a depression. Depression, very few people know the criteria for a depression. A recession is 2 quarters of negative growth. Most will know that have any form of economic. They don't know depression, and you know why? You're not meant to. You're not meant to. It's not discussed. It's 2 years of negative growth with systemic financial failure. Now, Britain created a concept, US created a concept, the Fed chairs created a concept. Britain was literally 2 full years from doing it, and they created a 0.1% growth quarter. What happened? It was the quarter where the most QE was printed. So you get stats. Let's start that one again. Lies, damn lies, then stats. If you want to fudge not having 2 years of negative growth, you throw 400 billion at the problem, which you've just conjured up in a computer, and you push it through, and you create a statistical anomaly that just pushed you through 0% to 0.1, so that you can actually have one sole quarter that disallowed a 2-year period that would have qualified you for a depression. That is monkey business. There was systematic financial failure. Lloyds, Royal Bank, Bank of Scotland, Northern Rock. We're talking every major bank actually ended up in some form of bailout, in the US as well. Hedge funds collapse, Bear Stearns collapse, Lehman collapse, bailouts of car motoring companies' financial divisions. with supposedly the exception of Ford, although they got support in a very subtle other way. So you're talking about not just banks being bailed, you're talking about even car companies in the States who got into banking with financial leveraging every product. If I was selling widgets, one of the first things I would do is become a key critical industry, pump the price up, create HP on it with residual values, and sell it in monthlies to Americans who don't know how much they're paying for the widget, and therefore make bulk of my profits as a bank selling loans for buying ABC widget. You then become a massive loan book. You're a problem. You cease to be your own problem when you're in trouble. You're now the Fed's problem and you get bailed. That's what's happened. It's a control structure fraud perpetuated where the taxpayer is the victim. And the key moment is if the trade wars start kicking off, if protectionism starts kicking off now, and this is all coming, it is the perfect storm of rising interest rates. We've already, and effectively in October, it's 2 months away, we've already effectively run the full gambit that most cycles run. The interest rate forward guidance and the increases have been accelerating. So initially they started slow, they've gone slightly hyperbolic. So this is escalating while normally they've been more graduated, and it occurred in 34 months. When this blows, this isn't the hand grenade. This is a hand grenade in a petrol station that is strapped to a nuclear reactor. The scale will not be one bloke losing his flipping head and some lead stuck in the wall. It's a fireball followed by a nuclear flipping meltdown. That is the difference. Because you've been driving at 200 kilometers per hour and that dagger is stuck against your sternum and you're as drunk as a lord, but they've injected that alcohol into you slowly but surely, and you've now crossed the line. And you've been given the wheel at 200 kilometers an hour with faulty old drum brakes and a major emergency stop required before a concrete wall a couple of meters down the road. And that is how it's all going down. That is how I see how precarious this is. The interest rate yields, the leverage, the debt, there's no more globalization that you can do that can allow for such low interest rates without creating inflation. Eventually it comes. The destruction and the quantitative easing that created all of this, the banks, and all, referring to my Rycards material that I've done in other clips, all the easing of leverage requirements that were originally intended in the Basel, that all the likes of Geithner, the likes of Summers, all quietly took back off the table to not spoil it for the banking industry boys that are still out there. And in fact, they went the other way. They even went further the other way. And the people who are having their leverage wind down is Joe Schmo with his spread bet account in the UK with IG Index or CMC, who's told you're not professional, you can only punt that much. And the real leverage has gone up even higher for the institutions. It's an absolute laugh that this has happened. And hear me now, cash will be king, but be careful where you put it, because there's very few places that won't be affected by this nuclear holocaust. You need real hard value. Anyway, I'll be doing a webinar on the 31st of July around it's not what you make, it's what you keep. And believe you me, these guys are creating volatility on such a scale that keeping any of it is going to be tough, and you better be very careful where you put it. I fear that on balance of probabilities, that reckoning moment is coming closer than it's ever been. And this September, October, November period could be pivotal, and the sudden drop in superstar Facebook's earnings that has now come out in the 2 days are showing that a lot is built on vaporware. A lot of pricing and valuation is built on vaporware. Looks like it's fallen from around $220+ to around 175 in a flick of a switch. That could be just the beginning of a tech shakeout. And believe you me, they've been very dominant. They've been pushed to the moon, and there's been a lot of money chasing into that. Anyway, so we'll see you 1900. If you, by the way, it's going to be a solution involving trading, potentially making the most out of any great fall in the markets. It doesn't suit everyone, and it also has to be equity that you can afford to place at risk. It truly doesn't suit anyone. And also on top of this, as much as I'm saying it's precarious, I can't guarantee anybody on time. But at the moment, I will say there is a perfect storm where there's tinders being struck and causing sparks around some seriously inflammable material lying about the place. And when it goes, it's going to go big. And I always supposition that it'll be on Republican hands and on a new Fed chair. And we are there right now, first termer. So watch out. Make sure your plan, if you don't already have one, is as good as it can get, because there's napalm in the air. Bye for now.